Hey guys, welcome back to our channel, Invested. Good to see you guys here. Another great question, and I'm taking this question because there is something asset class in there called co-living, and some people have heard about it, some people haven't. So I wanted to kind of define that and give this person some information as well. Can I force appreciation with long-term co-living on 9.5 million MF deal? MF is multifamily. Hello, good people. I have 30-unit multifamily property under contract in a fantastic location in an urban core of strong submarket that is large magnet for recent college graduate. My architect and code consultant tell me by sacrificing the living room of 1 bedroom and 2 bedroom units, you can add additional 45 legal bedrooms to the property. Hypothetically, I could double the NOI in the property assuming I'm able to stabilize with 12 months long leases. My questions for the class are 3 questions. Is there a product out there that I could use to finance a co-living model? Second question, would any premium in rents received be financeable, especially if they're 12-month leases? Third question, if there's a product or a bank out there willing to lend, do you think any valuation would be weighted or risk adjusted for this model? My thought is that as long as we have stabilized property with 12-month leases, then banks will be agnostic when it comes to how it is achieved. Thank you all for your insight. Great question, well outlined, thoughtful. I like this person. So number one, before I answer the questions, I think the co-living asset class, I mean, you may have heard of it, co-living or flex spaces. So think about co-living as glorified dormitory for adults. So people went to college, you guys probably lived in dorms or had roommates. So co-living is essentially for recently graduate people or young professionals who are making their way through their career, but they just can't afford within their budgets go get a 1 bedroom or studio. They still have to take on essentially roommates. But the newer co-living spaces are kind of built like a dormitory. So if it's like 4-bed or 3-bed co-living unit, newer one's gonna have 3 individual bedroom. I'm not saying it's large, it could be like 9 by 10. And then you have to have shared bathrooms, or someone may have their own bathroom if they want to charge more rent. But your common areas are shared. So essentially your living room, your kitchen, your balcony, everything else is shared amongst those individuals who's living in that unit. So think of it as your roommates. So that's what the co-living asset class is looking at. And they fall under multifamily, of course, right? So co-living became really popular. Of course, it's been popular in Europe and Asia just because of density, but it's been becoming more popular in the United States. About 10 years or so, it's been really coming into play. But you'll see more of these in like San Francisco, Denver, Boston, LA, where there's high concentration of density with robust public transportation, because most people living in co-living is not going to be having cars or vehicles. They may, but they're trying to reduce costs. So what this individual is trying to do is taking a traditional multifamily and carving it up to create more rooms, right? And that makes perfect sense, because if you have, essentially one big giant piece of bread, let's just use just, a sliced bread, right? When they're big, it's a big giant bread, and you can sell that. Or you could chop it up and make it into sliced bread and sell it individually, right? So it's essentially it's a Costco to retail model again. So this person is essentially, I like the word force appreciation, but it's really not force. It's value add appreciation. They're adding additional value to this standalone multifamily by adding more rooms, which will increase your top line revenue. That's just normal, right? Because you have more rooms to rent out. So I think it's a great strategy with a lot of traveling nurses and young professional that has really tight budgets. This asset becomes very attractive. So I think it's gonna do well. It's a good asset class, but it's gonna be very specific market driven. Okay, you can't be doing this in like Birmingham, Alabama. It doesn't work. But you can do it in San Francisco, maybe Seattle, Boston, highly concentrated area that has a good population. So the first question is there a product out there that I could use to finance a co-living model? And co-living model fall under multifamily. So as long as you have in-place NOI, which is net operating income or EBITDA, the lenders are going to give you some credit for that because you have an in-place revenue generating asset versus if it was completely vacant. Then that kind of adds a different layer of risk for the lenders. So they're not going to be able to upsize or right size that deal. So if you have a little bit of income, they will take that into consideration and they will underwrite your credit, your background, your business plan, and the market itself to kind of see what the risk reward would be. So right now, the traditional bankers are not going to be able to do that because they see this as too much risk, because you are going to be taking entitlement risk, which is you're going to be permitting risk. Because if you're adding 45 legal beds, you're going to have to get a variance or CUP, which is conditional use permit, or SUP, special use permit on a zone variance. So that might take you 6 months, 9 months, 3 months, or even a year, or even 2 years, depending on what city it is, right? So they're going to take that into consideration. Then also your construction time, right? How much you budgeted for construction. Now you're telling me it's going to cost me $2,000 for this wall, this and that. Like, they're going to think you're stupid. There's no way, because the cost of hard costs and soft costs, which is construction, has significantly gone up. So they're going to be underwriting that. So with this model, you want to raise private money. So essentially going to your friends and family, or investors who are savvy real estate personnel, and being able to take their investment as almost debt or preferred equity, and structuring a deal that way to get your money instead of going to a traditional lender. Second, there are some going to be off non-traditional lenders who are private credit, who does real estate for a living, and they may like your ideas. They may like your locations, so they might underwrite the deal and give you a lending source. But those lending sources are going to come at a cost, right? Credit market is very tough. So you're going to be paying almost hard money loan, depending on how much money you're raising, right? So if it's like a $3 million, $4 million that you need for your renovation, or even more, they're going to size that plus like SOFR plus spread of like 500 bips or 600 bips, point in, point out. So it's going to cost you like the mid-teens for that debt or that financing. So you got to take that into consideration from your interest reserve perspective too. So look at both that way. Traditional lenders are going to be very tough right now. Second question, would any premium in rents received be financeable, especially if there's a 12-month lease? Most lenders and most creditors who will give you financing, they want to see the history, right? So if you have 12 months and you're stabilizing at like 95%, they'll definitely give you the credit. Now, if it's a 6 months, not really. So if you have about 12 months stabilization history, they will say it's less risky because you have a track record or proven operational history in this particular asset. So they'll probably upsize that loan for you. So yes, the short answer is yes, it's financeable if you have 12-month leases. Third question is, if there's a product or bank out there that are willing to lend, do you think any valuation would be weighted or risk adjusted for this model? It will be weighted and risk adjusted on multiple facets of their underwriting. Number one, it's going to be your assumption, right? How much rent are you setting for these new rooms? Are you mark to market existing rent? So if the overall rents are lower than the market, they're gonna see that as a plus. But if you're over market or at market, they're gonna see that as risky. And weighted essentially gonna be, it's multifamily, so it's gonna be weighted on time. Is all those units gonna be rolling over at the same time? What is your rollover in the next 3 months at a time? Is it 25%, 60%? Then if that's happening, how much CapEx or reserves do you need for refurbish, right? Or unit turns? It can be simple as cleaning, but most multifamily, you probably know this too, multifamily underwriters, if it's a new asset, they might reserve $250 to $300 per unit per year. Now, if you have an older product that's going to be outdated with no residual value on the finishes, then you might have to hold back $500 to $1,000 in your reserve. So the lenders will look at that weighted, how much turns you need to do. So then they might sweep those in an impound account as a CapEx reserve. So that will restrict you from utilizing your capital because they have a sweep account. So think about those when you're talking to the lenders. And I appreciate you asking this question. Hopefully that was helpful. If you found this content helpful, please like, subscribe, and ask more comments. Thank you very much.